That's going to be the one that we use to value the stock, and then we're going to compare it against the stock price and make a recommendation in the derivative trades. Okay? All right. So, what do we have for perpetuity? What's the other one?
Loan growth.
What's the next one?
Multiple.
Approach, and then what's the last one? Got it. Okay, so that's the valuation models. And then what were the values?
For perpetuity, 175. For Gordon growth, 200.
175, do we have any like pennies? Because we like to do two, we'd like to do to the
It was
second
just
decimal.
175 flat,
Okay. And then what about the Gordon growth?
200.
200.
Okay. And would we come up with the multiple approach?
210.
200, oops. 210. Got it. And what did we come up with DCF?
183 and 38 cents.
Then what we're going to do is we're going to come up with a few scenarios. S1, S2, and then do S3 over there. And then move it to the right a little bit. So we're going to need some space. Yeah. Just do S3. Okay, cool. All right, thank you. All right, so let's go through. Plan this very well. But I'll live. All right. So what we're going to do is we're going to do three scenarios. We're going to do three weighting schemes. And then what we're going to do is we're going to pick the weighting scheme that we're going to use to do the final intrinsic valuation. Will be the one in the middle. Okay. So let's just survey. If you were going to weight these methodologies, which ones would you weight the most? And which ones would you weight the least? Which ones are the most accurate? Multiple approach and DCI. So, you know, everything has to add up to 100%. What would be your weighting? What would be your weighting sensitivity underneath the first scenario? You're the analysts. I'm just a scribe. Basically, I work for you, so you tell me. Under the first scenario, let's just do a scenario. Just throw out some weights to me to make sure they all add up to 100%. Okay, so what do we know about the logic? What's the logic? What two scenarios are the most important for valuation purposes?
Cash flow and multiple growth.
Exactly. Okay, and which one are the two least important? Perpetuity and Gordon growth. Okay, so based on those rules, how would you assign the weights to each of the models based on their importance?
More to multiple approach.
Yeah, but give me some percentages. Actually, give me a number.
Like 40 and 40 and 10 and 10.
Okay, so we'll start off with that. So 40%, 40%, 10%, and 10%. Got it. Okay. Anybody else? Now, I know you all have an opinion, right? That's what your parents told me when I called them. It's like, oh yeah, she's very opinionated. So, that can't be the only weighting scenario.
45, 45.
What is it?
45%, 45%, 5%, 5%.
Okay. 45, 10%?
5%.
I got it. 5% and 5%. Got it, okay. Anybody else have an opinion? And how you would weight it to come up with the most accurate intrinsic valuation, weighted average?
You have to use all four.
Yes. I mean, technically you wouldn't do it in the real world, but and we're kind of in between the real world and the fake world, so we're kind of in between. There's still, what I'm finding out is over the years, when we do this approach, that the valuations are actually starting to cluster together. I'm not getting huge variations. So we're actually doing a pretty good job of valuation, even using perpetuity and Gordon growth. They're actually coming in fairly close to DCF in the multiple approach.
You can do 3%, 3%, and then 47%, 47%.
So I got a 3%,
3, 47, 47.
47, 47. Okay, that's one way to do it. Some people would give the DCF more and then the multiple and then either do 10, 10 or 5, 5, like that. But we can do it this way. Okay, so let's do the valuation. So everybody's got their calculator, so we can calculate this out. So the way I like to do it is like this. Don't need it anymore. And the math gets kind of easy when you're using 10%. So what's this? 10% of 175.
17.5.
You got it. Okay, and this one?
20.
20. Got it. And what's 0.4 times 210?
84.
What?
84.
Okay. And what's 183.38 times 0.4?
73.
Love it. Okay, and then sum those up, and you're gonna get the weighted average under the first scenario.
Do we want to say 73 or 73.35?
I'll take the 3 decimal points, or the 2 decimal points. If you got it. Because when you're a securities analyst and you're giving an intrinsic valuation and stock recommendations, they actually take them out to the pennies. Okay, so what does this sum up to be?
$194.85.
194 point what?
85.
85. Okay, so what I'm gonna do, I'm gonna put you on hold for a second. Because what happens is the students will, I'll ask them, I'll say, what scenario do you think is the most theoretically correct? Or which one do you think is the most accurate? Just based on the weighting schemes for the different scenarios. And what they'll do is if I calculated everything out, they would pick the one with the highest value, which is incorrect. Okay? It's rules-based. Okay? We really don't care about the valuation. What we care about is application of theoretical accuracy, okay, based on theory. And we know that basically the multiple approach and the discounted cash flow approach are the two main valuation methods that everybody uses to value stocks. We just happen to add in perpetuity and Gordon growth for the exercise. Okay? And it's a more elegant model like this too. So my question to you would be, right now, is which scenario do you think is the most accurate from a theoretical standpoint? Now the problem is you've equally weighted all of them. You didn't give more weight to one methodology over the other. So the question becomes, what scenario, again, do you think is the most accurate? And it really boils down to, how much weight do you want to give perpetuity and Gordon growth? If you think perpetuity and Gordon growth has information in it, then you would weight it more. If you think perpetuity and Gordon growth doesn't give you enough information, then you would weight them less. So it's really up to you to decide. You weight them less, you weight them more, or somewhere in between. So in this case, the decision rule is not based on multiple and DCF. In this case, it's how much weight do you want to give perpetuity and Gordon growth? Do you want to give it more or less?
I wanna give it
What?
even, I wanna give perpetuity even less, but Gordon growth slightly more.
Well, we can change the weights if we want to. If you want to, we still can change the weights. If you want to, you have to tell me. This is you as the analyst. This is what analysts do.
We have decimal place percents?
No,
Oh,
If we're not looking for the highest value, what exactly are we looking for?
theoretical accuracy.
Oh, okay.
We know that DCF and multiple approach are the two main valuation methods, that are used to value the intrinsic value for securities. In this case, nobody came up with a strong opinion on weighting multiple or DCF more than the other, because you just split it. Okay, yeah.
So would you not give like perpetuity and Gordon growth at the least percentage possible?
I wouldn't give them as much as DCF or multiple. If you think that the market multiples, comparable companies, multiples for valuation purposes is the most accurate, then you would weight multiple more. If you think that your 5-year projection, is more accurate than the multiple, then you weight the discounted cash flow more than the multiple, but you give the multiple and DCF the majority of the weights, because they're the most accurate in the valuation process. So I'm willing to change the mix between here if you have a strong opinion. But really what it boils down to, since you split the weights here, is how much weight do you want to get? How much weight do you want to get? Perpetuity and Gordon growth.
well, since perpetuity doesn't account for growth, but Gordon growth does, when perpetuity best served at 1% and Gordon growth at 2.
And you could do something like that if you wanted to. If you want to do a scenario like that, we could do a scenario. Or you could also take from here, to redistribute. But you can't, does perpetuity have some information in it? Yeah, so you can't totally underweight it, because it does provide you with basically a base number, right? So it does give you some information. So what do you want to do? This is the real world. This is how they do it. They ask you questions, and then you have to make a decision. Right? It's like in sports, right? They throw you the ball, what are you going to do? What do I do with this? You tell me what to do with it. You're going to take it and you're going to shoot, right? Drive on the player and stuff like that. Yeah, you're going to make a decision. And it's got to be decisive, right? Yeah, absolutely. Same thing in finance. You got to make a decision, you got to be decisive. Because you can't wait around. So what do we do? You want to leave it? Move on? I'm just scared that you're going to pick the highest value, which is totally arbitrary. You're not thinking through the logic. You're not using rules to make your decision. You're using emotion, which means you're going to make a mistake.
So what one would be the best to pick between multiple DCF for like this example?
It's really up to you.
So why
Some
would-
people have done 55% DCF or 55% multiple, they give 45 to the other. They just feel stronger about one method over the other, and then they either split it. In most cases, they'll just split it between Gordon growth and perpetuity.
What did you want the, like, if, going back to his question, like, why would you not want the highest if it gives you the best, like,
Because
valuation?
that's not your goal. Your objective is not is a high or low number. Your objective is weighting to best. We know that multiple and DCF are the best methods. Okay. The question is, do you feel more strongly about one over the other where you're gonna give it slightly more weight. And then the others, you just give the balance to the other two. I mean, they provide information, but they're not the main methodologies that are used to value stocks. Yeah,
We change scenario 2 to
which one?
scenario 2,
Yeah, the one,
43 for multiple approach,
43?
41
Why don't you just do
DCF.
40?
Yeah, 43 for multiple,
Why don't you just do 40?
40,
Make the math easy.
let me read it now. For DCF,
Something like that.
yeah, then we can do,
That's a pretty good approach, I'd leave it at that.
36 and 4 for the
What do you want to do? Over here?
Yeah, can we do 6% for perpetuity? No,
Where?
I mean,
No, I'm gonna leave it like this.
really low?
Keep it easy.
Okay.
Don't overthink it, just keep it simple. This basically tells you that you value DCF over the multiple approach, but you're still giving multiple the majority of a significant portion of the weight, which is accurate. You're just underweighting perpetuity and Gordon growth because of their simplicity.
Oh, so they'll always be the same, about the same?
Yeah, I would leave it the same, or you could weight this a little bit more.
Okay.
You know, but if you wanted to weight this more, I'd probably take it from one of these. Right, because you want to keep the numbers simple, okay?
For scenario 3, could you do 30 for multiple approach and 70 for discounted
I
coverages?
probably wouldn't go that high,
No?
no.
Why not?
You're weighting too much the one method. If you go 70 and above, what you're doing is you're basically wiping out these guys, and almost all of your weight is to the DCF, is that what you wanted to do?
Well, yeah, because aren't they the most accurate forms of,
Yeah, but when you go to 70%, you might as well go 100. Because that's what, the math will come out, where basically you've weighted everything towards DCF. And you're not really giving anything to multiple. And actually Gordon growth does give you some information, and perpetuity is just a base. But I wouldn't weight it that much, maybe 60, maybe 60-30.
is that the highest you would go then? 60?
I wouldn't go 70. 60 is probably pushing it, but I'd do 60, but that's the upper bound. I wouldn't go beyond that. So you want to do that?
Okay, yeah.
So 60 for DCF
Mm-hmm.
or multiple? You could
For
argue both.
DCF,
Okay,
yeah.
60. All right. And then what about the multiple?
Probably 40.
Well, that's 100, so you give nothing
Oh,
to,
shoot,
you
yeah.
didn't leave anything up left over.
Yeah, 35.
Don't you mean 34?
Do 2 and 3.
Yeah, and then 2 and 3 for perpetuity and Gordon growth. 2 for perpetuity and 3 for Gordon.
Which one?
2.
Review.
Everybody okay with those? Is that good enough, or do you want to make an adjustment?
You say you go no higher than 60%. If we were going off that basis, what percentage should we go no lower than? For
Well, basically, when you start going into the 1s and 2s and 3s, it's not going to have a material effect. So you're not really weighting it. I mean, 5%, 10%, you're getting some credence to the perpetuity and the Gordon growth model.
I'm talking in terms of multiple or DCF.
What are you saying, the max or minimum?
Yeah.
I probably wouldn't go under 40,
Okay.
because you want to give those two the majority of the weights. You may just have a preference over one or the other, in which you're going to weight more than the other. And then the balance usually goes to perpetuity and Gordon growth, and if you're more accurate, you give a little bit more to Gordon growth because they have the constant growth component to it. Or perpetuity assumes that the cash flows remain flat forever, which is highly unlikely, for a lot of these companies. I mean, a lot of these companies are real estate or growth companies, so their cash flows are going to grow. Any other questions? Okay, so a lot of the stuff is theoretical, right? And you're gonna need to argue this, you know, in front of the board. They're gonna ask you, you know, why did you weight that 60%? I would never have gone 60%. Why did you feel compelled to weight it 60 or 70%? What was the rationale? And then you'd say, well, I gave 70% because I felt that our 5-year projections on the cash flows were extremely accurate. So you argue it out, right? And then you defend yourself. All right? So this one's not changing. So let's do this one. Scenario 2. Of these 3 scenarios, which one do you like the most? Let's take a little vote. You know, just based on weighting scenarios, based on theory and application, what scenarios do you think, which one do you like the most? Do you think is the most accurate from a valuation standpoint? How many people say scenario 1? Who came up with scenario 1? Okay, who likes scenario 2? And scenario 3? Okay, awesome. So we'll calculate that. We'll use scenario 2 as the scenario to come up with the intrinsic value. Okay, all right. So 0.05, 0.04. So what's $175 times 0.05? What is it?
8.75.
Okay, and just yell that out. Yell that out. A little louder.
8.75.
Thank you. In corporate America, we all yell at each other. You yell and constantly yell. We're not very meek. You know, we're not that quiet.
10.
And then 200 times 0.05.
10.
Got it. Okay, and then 210 times 0.4.
84.
Got it. Thank you. And then 183.38 times 0.5.
91.69.
91.69. I love it. Okay, and then if you add those up, what's the weighted average or the intrinsic value? What is it?
194.44.
Is it pretty close? It's pretty close because these are close. Okay. And then let's do the third scenario. And that's when we gave a significant weight to the DCF. Okay. So what is 175 times 0.02?
3.5.
What is it?
3.5.
Thank you. And then 200 times 0.03.
6.
And then 210 times 0.35.
73.50.
And then 183.38 times 0.6.
110.028.
Okay. Got it. And if you add those up, what do you get?
$193, I believe.
93.
From that, I did it in my head.
Okay. So you're only off slightly, right? Okay, so this is the intrinsic value we're going to use.
Earlier when you said the middle value, did you mean the median between all 3, or did you mean?
No, just the scenario.
Okay.
Scenario 2. What I like to do is I like to set up my my weighting scenarios, and then I pick the scenario that I like, that that I think is the best theoretically, and I put that one in the middle. So what I'm doing is I'm testing a range, right? And then I focus right in on the intrinsic value. Okay. So what's the next question? Not the next question, but what's the next question on that? Okay, what is the intrinsic value of the stock? Got it. What is the weighted average calculation? We did it. And if you were asked to give 3 weighting scenarios, which we did, what would they be? Okay, we already set those up. Why did you choose those weights, and what are your arguments for the weights? So we felt that we wanted to weight the discounted cash flow more than the multiple approach. What is your trade recommendations? Okay, so let's see. Okay, what's the intrinsic value?
194.44.
194.44, got it. And then what's the current stock price?
157.
157. Got it. Is the intrinsic value more or less than the current stock price? By how much? What's the premium?
47.44.
How much?
47.44.
47% premium.
It's
Oh,
37.
no. That,
Can you calculate a percentage change between this and give me the premium? Or take this and divide by that, minus 1 times 100. That's another way to do it. Do you guys know how to calculate percentage changes? If you don't know how to calculate percentage changes, you need to tell me right now, because you'll be doing a lot of percentage changes.
23.
It'll be extremely embarrassing when you go to your boss and say, I don't know how to calculate a percentage change. Okay, just do this. What's 194.44 divided by 157?
1.24.
24? 24%? Right? Boom. It's the easiest way to do it. Okay. So 24% premium. Now that premium is right around 20%, which is, do you think a stock price could go up 20% in 12 to 24 months? Do you think a stock could go up 24% or maybe 12% per year over the next 2 years? Is that probable? Yeah. What if this was like 124%? You guys made a mistake.
That'd be nice.
You know, if you made, well, it would be nice, but you probably made a mistake, and the investment committee's going to think that you made a mistake. Unless, you know, you can justify it by the numbers. So 24% is totally reasonable. Okay, got it. So what would be your recommendation? All right. Hello, proprietary trading unit. We just conducted the equity analysis on Intel and IBM, and we came up with a 24% premium, and our target price is $194.44. We recommend that you
buy.
buy. Oh, and by the way, we were valuing IBM and Intel. And IBM and Intel make up a significant portion of the technology stock indices. So we also recommend, based on the indices, the technology stock indexes. We also recommend you and our institutional clients to trade the following derivative contracts. We recommend that you tell me. You guys have done the memos already, so you know exactly what it is. And it was on the exam.
Right.
What are you going to do? If you think that the stock price is going to go up 24% over the next 12 to 24 months,
Buy it.
you buy forwards. Got it. What else?
Buy futures.
You buy futures. Got it. What else would you do?
Buy calls on futures.
Buy calls on futures. Got it. And what else?
Right puts, oh, sorry.
You write puts on futures. Got it. Now, obviously, we're gonna be trading, multiple indexes, but just based on this, how many trades do we have? How many trades? How many trades?
4.
4? Got it. Got it. Okay. Do you think that IBM and Intel make up a significant portion of technology, stock, exchange traded funds?
Yes.
Yep. And proprietary trading unit clients, based on our research, we recommend that you place the following trades on tech, stock, exchange traded funds. Those trades are now you can always review your notes.
Buy on margin.
What?
Buy on margin.
By a margin. Got it. What else? We also recommend that you
Buy calls.
buy calls. And we also recommend that you
Right puts.
write puts on the following technology, stock, exchange traded funds. Okay. How many trades do we have?
3.
3. We also did this research on IBM and Intel, but IBM and Intel are similar to other technology companies within the same sectors. So we also recommend for these stocks and for other stocks similar to these types of companies, that we recommend that you make the following trades, which are
Buy on margin.
margin. Got it.
Buy calls.
Calls. And
Right puts.
puts for a total trades of how much?
20.
20 trades.
No, 10.
Got it. Okay. Actually, it should be 12. I screwed up. There's really 4. I should have put it right here, but I didn't. Because one of the trades are also to buy. Just buy the stock. So there's really 12 trade recommendations that I could make my client, give to my clients or give to the proprietary trading unit, or for me, for my personal account, to use the research that we conducted to make these trades so that we can make some money. At the end of the day, we need to make some money because we gotta send Johnny and Joni to college. Okay, and that's gonna cost $500,000. Okay, so we need that. And I don't want you guys, borrow me money to go to college, I want to pay for it myself. Okay, so that's that answer right there. All right. What other stocks are you trading? Technology stocks, researching. This is all extra credit right here. We're not going to talk about those. The next question is the last part of this is really if you were in my investments class, right? It's like, what other stocks are you trading? What other stocks are you tracking? Researching, recommending to your clients, it's probably Salesforce, it's probably, what else? Maybe you're doing all tech, Cisco, and then you create a portfolio and you give it weights, and then you calculate the expected return on the portfolio. Okay. So let's do the next one. The next one is a similar, we're not doing tech companies, now we're doing real estate. Okay. And we're gonna do, what we're gonna value is what are called real estate investment trusts, or REITs. Okay. Anybody ever heard of REITs? 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 Anybody ever heard of REIT? A REIT? REITs are awesome. In 1960, Congress was nice enough to pass the Real Estate Investment Trust Act. That basically stated that real estate companies that basically own and manage and develop and generate the majority of their income and earnings from real estate don't have to pay corporate level income taxes. Right? So what they can do is they can pay out the majority of those earnings as dividends to their shareholders and increase the dividend yield on those stocks, which makes them extremely attractive, thereby attracting capital into the real estate industry that then creates private investment for real estate construction and investment. Brilliant, brilliant tax cut. Okay. I bought a bunch of REITs. I mean, they've just gone up over the years, and they pay me a good dividend every quarter, and I just gotta buy more and let the money come in. It's kind of easy. You don't have to do anything else. Okay, so we're gonna value the REIT. All right. So, so give us the information. What is the cash flow metric that we're using for this? What was the cash flow metric we were using for the prior?
Discounted?
Huh?
Discounted cash flow?
No, what's the cash flow metric? You know, if we were using earnings per share, what are we using this for this case?
FFO per share.
Yeah, funds from operations, so it's different. It's basically a free cash flow metric that's specifically designed for valuing real estate securities, equity securities. Okay. All right. So what are the four methodologies? I know you're getting sick of this by now, so I know when I start to see God, he's starting to bore me, that I know it's sinking in. Right? Okay. So we'll do perpetuity. I believe in the 5 rule. You tell somebody over and over 5 times, and when they tell you I'm sick of it, I get it, that's when you know they get it. Okay. All right, so what do we need to do? Yeah, we need to calculate the FFO per share next year. 2 + 1, and then what do we do? Yeah, or the discount rate or the expected return, what are we using for the discount rate? Are we using WACC, or what are we using for the discount rate?
Expected return.
Yeah, we're doing the expected return. Got it. Okay. Okay. So what's the cash flow for next year? What's next year's FFO per share? How do you get next year's FFO per share? What is it? No, we've already done this like 3 times.
15 times 1.8.
Got it. Okay, so we got $15, which is the FFO per share this year, and the pro forma projection growth rate for next year is 8%, so 1.08. Got it. Let's see how fast we can do this one. Okay, since we've already been through it 3 times, let's see how fast we can do this. Okay. So what's $15 times 1.08? See how fast you can do the calculations. You do it in your head.
16.2.
$16.20. Got it. And what's the expected return?
8%.
Got it. So what is the intrinsic value using the perpetuity approach? Come on, hurry, fast. See, as fast as you can go. The Harvard guys would have this thing done in a second. next model?
Gordon Grove,
Got it. Also called?
constant growth.
Got it. Okay, what's the model? Start yelling, it's the oral, this is the oral part too, to see if you can find it. Following, so you just yell out the answer.
FFOPS T plus one over, same thing, yeah, I and then constant, right?
Yeah, minus,
G.
got it. Okay, so it's gonna be what, 1620 divided by 0.08. And what's our constant growth rate that we're using? 2%. Got it. And 0.08 minus 0.02? Come on, you guys. Engage. 0.06. Okay, what's 16.2 divided by 0.06?
270.
What's the next model? Okay. And what's the math behind that? How do we calculate the intrinsic value using the multiple approach? Cash flow next year times multiple, got it. So what's the cash flow for next year? 1620. Did they give us any multiples? Did they give us expected returns? Did they give us multiples anywhere? Did they give us multiples any place on the sheet?
15, 22, 25.
Got it. So we got 25, 22. Is that right?
Yeah.
Okay. And then what's the other one? 15? Got it. Okay. So what's 1620 times 25? What is it?
405.
Is that correct?
Yes.
So 405? Any pennies?
No.
Nope. And then what's the 1620 times 22?
356.40.
What is it?
356.40.
Thank you. And what's 1620 times 15?
243.
24300.
Yeah.
What's the next method? DCF. What are we trying to calculate? Present value. What's the first thing we need to know? What's the holding period? What's the holding period?
5 years.
Got it. And how many cash flow years do we need? 6. And what do we use the 6 year for? Terminal value. What do you want to calculate first, numerator or denominator? Numerator. Okay, and what's the first year cash flow? We should do a little sing-along. I'd like to hear it from a lot of people are singing along in Larry's.
16.2.
1620. Okay, and how do I get year 2?
Times that by 0.06.
1.06, got it. And what's 1620 times 1.06? 17 point what?
170.
172, like that?
17.
I mean, I don't know.
don't do 3 decimal points. Okay. And then how do I get year 3?
Times 1.04.
1.04. Everybody know where we're getting these growth rate numbers? Okay. So what's 1717 times 1.04?
17.86.
Got it. And then how do I get year 4?
Times that by 1.02.
1.02. So what's 17.86 times 1.010?
18.22.
18.22. Okay, I only hear one person, although Max, I love you, I trust you, but I need some input from some other people.
Yeah, I want to be wrong.
Yeah, I don't want you to be wrong.
I want to be.
So anybody else? You'll get no more cookies if you. So is that correct?
Yes.
Okay. And then how do I get year 5?
18.22 times 1.01.
1.0 what?
Oh,
1? Got it. So what's 18.22 times 1.01?
18.40.
Okay, 18.40.
Can confirm.
Okay, and then what do we do now?
5 year 6.
Yeah, we gotta calculate the 6-year cash flow, and then how do we do that?
18.40 times
1.101,
1.01.
and that gives us what?
18.59.
Thank you. 18.59, and what do we use that for? Calculate the terminal value. How do we calculate the terminal value?
Wait, what? I got 18.58.
Okay, you guys can arm wrestle, okay? And whoever wins can have it. Max, what did you say?
18.58.
Okay, I think Max can take you. Okay. We'll make Max happy. So what are we gonna use the 18.58 for? Terminal value. Okay, so how do we do that? What do we use? Yeah, so we're gonna use terminal discount rate of what? 0.1. Got it. Minus what? What's that? Terminal growth rate, negative 0.01. That gives us what? 0.09. Got it. And why is the terminal discount rate higher than the going in expected return? You gotta account for risk. Excellent. Okay, so what's 18.58 divided by 0.09?
206.4.
What is it?
206.4.
Got it.
4.
0.4?
No, 4.
4.4?
Yeah.
Got it. Okay, what do we do with that?
We added the numerator for year 5.
Got it. So we're gonna add it. And last year's cash flow. And that's gonna give us what?
Do you want me to say it?
Yes, please. What is it?
224.8.
Is that correct?
Yeah.
Got it.
Yes.
What do we do next? What?
Motion is nominated.
Yeah, what are we gonna calculate? What are they called? No, the discount rates are what we're gonna plug into them. But we're trying to calculate what? What are these things?
Present value.
Well, that's what we're gonna get to.
Sorry.
But what are these things called? No. We're gonna put the expected returns in there as the discount factor. Oop. Damn it. Yeah, I said it. So what are we calculating? Discount factors. What's the discount rate?
8%.
8%. And what are we using as the discount rate?
The expected.
Expected return. I'm just asking questions over and over again. Okay, got it. this is to the power of what?
One.
One, this one? Excuse me. And what's 1.08 to the one?
1.08.
What's 1.08 squared?
1.17.
Got it. What's 1.08 cubed?
1.26.
Okay. You guys gotta be calculating this stuff, okay? You can't sit back there, you gotta get on your calculators, calculate, okay? What's 1.08 to the fourth power?
1.36.
And what's 1.08 to the fifth?
Yes.
Like that?
Yeah.
So what do you wanna do, start in the fifth year or the first year? First year, okay. So what's 1620 divided by 1.08?
15.
Oh, that's nice.
What?
That is exactly 15.
I love it. And what's 1717 divided by 1.17?
14.6.
And what's 17.86 divided by 1.26?
14.17.
Thank you. And what's 1822 divided by 1.36?
13.3. 13.4.
And what's 1840 divided by 1.47?
12.52.
Is that right?
No.
No. I got you.
What's
Ah, he did. Granted, you did ask him what 18.4 divided by 1.47 is. So
He
technically
did,
you got
it
it
was
right.
like 12 something.
Thanks, man.
So what's 224.84 divided by 1.47?
152.95.
152.95.
Yeah.
And then if you add those up, what do you get?
Yeah.
Yeah.
So we basically got, we really have three intrinsic valuations. We gotta figure out the fourth one. Okay. So let me tell you the story. In 2014, 2015, so that was what, almost 4 years ago, right? 4 years ago, almost 5 years ago. REITs were hot. They were, they were overpriced. People were willing to pay 25 times free cash flow, funds from operations. I mean, the stock prices just, went through the roof because there wasn't a lot of supply in the marketplace. And we were still coming out of the recession into the growth phase. It was like the perfect timing. Rents were spiking and no supply. The valuations were going through the roof. And then all of a sudden, the REIT market popped. And within a couple of years, all of this new supply started coming into the marketplace, which started pushing down occupancy rates and pushing down rental growth rates, and also putting downward pressure on REIT multiples. Okay, so you tell me, what multiple should we use? Do we use the multiple of the peak? Do we use the multiple of the most recent period where they were still elevated, or a more realistic multiple where REITs are currently today?
More realistic one.
Huh?
The more realistic one.
You want to be more conservative and use the more realistic one?
Then it looks closer to everything else that we got.
This is the this is the realistic scenario, but I want you to see, at one point, you know, they're all trading, what, around 220, 250, if you kind of average them out. The multiples, REIT stocks were almost double where they are now, because they were so inflated, and then they deflated. Okay, so I would rather use a more realistic scenario as opposed to a more optimistic scenario. Okay, great. And what are we gonna do now?
Scenario.
Yeah, now we gotta do the scenarios. What are the four methods?
Perpetuity, going growth, multiple approach, and discounted cash flow.
Perpetuity, growth, I know it's redundant, the method works. Multiple approach, and DCF. Got it. And then what was the valuation for the perpetuity?
202.5.
202.50, what was it for Gordon Road?
270.
70. What was it for multiple approach? 243. What was it for DCF? 210.2. Got it. That's one. That's two. That's three. So give me your scenarios. So what are the weighting scenarios for the valuation?
5.
Okay, so like 5%, 5%, 15,
50 and 40.
50, 50?
Yeah.
Okay. 40. Okay, so you think that the multiple's more accurate? Okay, got it. Okay, give me a second scenario. Go for it.
5, 5, 40, 50.
5, 40, and 50. Got it. Okay. Give me a third scenario. Somebody else. Go on, you can do it. I know you can do it. Just yell it out. It's like yelling out plays in a football game.
5, 35, 55.
Okay, well, that's kind of boring because we already have two fives.
3, 2, 3.
Oh, God, it's just, but that's insignificant.
10, 10, 40, 40?
There, I wouldn't do 40, 40.
Or we'll do 50, 40.
There we go. Oh, you want, you
I mean,
like the
no,
multiple?
my bad, I'm doing my math wrong. We'll do 10, 10, 40, 25, 10, 10, or 30.
Upside down. Like that. Is that a little different?
That's
Okay.
30%.
Oh, it is? Oh, darn it. Oh, God, that just makes things so miserable.
Nope.
No.
35%.
We do 35.
Okay. All right, here we go. Will that work for everybody? So how many people like scenario one? Think it's the best method? Raise your hand, don't be shy. Straight and tall. Okay. Okay, and how many say scenario two? Okay, how many people say scenario three? Okay, not everybody's voting. So that basically washes that approach. So let's try it again. It doesn't work when not everybody knows, okay? It works when everybody votes. All right. I mean, this is not a democracy, like in the United States, where not everybody votes, okay? So let's try it again. So how many people want scenario 1? There we go, 2, 4, got it. Scenario 2? Okay, 2, 4, 5. How many? Scenario 3? Okay, 2, 4, 5, got it. Okay, we got a couple ties. Okay, let's try it one more time, see if we can do a tiebreaker. Scenario 1? Okay, 3, excellent. Okay, scenario 2? There we go. Scenario 3. Okay, so it looks like scenario 2. Excellent. Okay, so let's do the mathematics. And what are we trying to calculate here?
Intrinsic value.
Yeah, we're trying to calculate the intrinsic value by using what method? What is it?
Weighted average.
The weighted average, exactly. This weighted average you'll see again when we calculated peer group for the financial ratio analysis in the final leg of the class, which we're almost there. Okay, so what's 202.5, or $202.50 times 0.05? What is it?
10.13.
Got it. And then what's 270 times 0.05?
13.5.
What is it?
13.5.
And what's 243 times 0.5?
121.5.
And what's 210 $210.20 times 0.4? 84.08. Anybody find a mistake? Okay, if you add these up, what do you get? What's the intrinsic value for scenario 1? $229.21. Got it.
Can confirm.
Okay. So let's do scenario 2. 0.0, 0.4, 0.5. We don't need these guys anymore. We don't need this guy anymore. Okay. So we already know what this is, right?
Yeah.
Cheated. So 10.13. This one's the same too. 13.50. What's $243 times 0.4? 97.2. Got it. And then what is,
105.
what is it?
105.10.
Thank you. Okay, so if you add these up, what are we calculating? The intrinsic value using the weighted average. 225.93, got it. And then we're going to calculate the last scenario. You already know what the first one is, right? 10.13.
27.
Yep.
Yeah, what is it?
27.
Got it. And then we already know this one, right?
Yeah.
21.0. And then 210.20 times 0.35.
70.
What is it?
73.57.
73.57. So if we add all these up, we get what?
232.2.
The intrinsic value of 2 what?
232.2.
0.20. Using what method? Weighted average. And then what did we decide? What scenario we'd like the most? What is it? 2. Scenario 2, because it doesn't matter what the value is. It's the methodology. important. So, what's the intrinsic value? 225.3, and then the current stock price is what? How much? 100. Is it more or less? More. By how much? What's the premium? What is it?
12%, like 13%,
13%.
roughly.
Got it. And your recommendation is what? 5. Now, could we also find REIT stock indexes where we can trade derivatives off of, based off of our view? Yes. We go find some REIT indexes or index. If we think the price is going to go up by 13%, it's probably going to pull up the index. So the index is going to go up. And what would be our index derivative trade recommendations?
Buy forwards, buy futures, buy calls on futures, write puts on futures.
I love it. Perfect. Got it. And how many trades?
4.
Could we go out and find REIT stock exchange traded funds to trade off of?
Yeah.
And what would be our first trade? This one's going to be a little bit different.
Buy.
Buy, got it. Nice, Max. Buy, and then what?
Buy on margin.
Got it. And the next?
Buy calls.
And the last one?
Right.
And how many trades? Got it. And then what about the stock?
Buy.
Yeah. Give a buy recommendation. What else?
Buy on margin. Buy calls.
Margin. Calls. And Professor Souza, you're teaching your students how to trade derivatives? Yeah, but they're only undergrads. So, you're just as smart as grad students. And how many total trades do we have?
36. Oh, 12.
Oh,
Yeah, we have 12. In the memo, we have 36. Thank you.
Yeah.
I think that's it. Yep, that's it. How much time do we have?
14.
14 minutes?
Mm-hmm.
Jesus, I almost like what? Oh, we do have 14? Let's save the real estate stuff for Monday. So we'll come back, we should be able to get through, I think, the rest of the exam either on Monday or Wednesday.
is there a typo or missing section?
What do you got?
I see C stock evaluation, the next
C,
page.
that's the stock valuation for the office.
And then I see next page, E, public REIT.
Okay, and then we just did the REIT.
Yeah, I'm saying, are
Right.
we missing a section or was that just a typo?
Oh, yeah, no. No, I think it was off there. And then we're gonna do a Salesforce Tower, which is F on page 5, and then we're gonna do Mission Bay, UCSF. 6, and then we've already done the investment decision-making matrix, We did that on the first problem.
Yeah.
So we'll go through that one more time for review, and then that's it. And then the other stuff in the back, you don't have to do unless you want to. It's just more propaganda. You don't have to do it. It's just so that you see what the kind of problems that the accreditation are looking for when they test you guys.